Good afternoon, everyone. My name is Marissa, and I will be your host and administrator today. Welcome to the Abernathy Group Family Office November 2024 First Friday meeting. Today's presentation is titled War: How to Invest Amidst Uncertainty. As we mentioned last month, we are going to discuss risks everyone is aware of, yet very few investors are actually prepared for. So we're going to start off with a question which may make you feel a bit uncomfortable, yet which is important to ask and to have answered. Are you prepared for an unpleasant future to become a reality, which we all fear? If your answer is no, you are not alone. In fact, you are in the overwhelming majority of investors. This is not a question we pose lightly, and we are not trying to become scaremongers. While we hope and pray none of the risks in front of us become reality, several evident risks continue to increase in probability, and it is our job to make sure each member of our family office remains prepared for both positive and negative events. Today, our prepared comments will be recorded, as other families who are unable to attend have asked for the recording. Our comments today will be approximately 20 minutes long, leaving us plenty of time to take questions from participants. If questions arise from the content of today's presentation, please either send the question along by typing your question into the chat box at the bottom of your screen, or write it down and raise your hand at the end of the prepared remarks by clicking on the icon at the bottom of your screen. I wanted to remind you that we really do enjoy your questions, and we will do our best to get to your questions at the end of the prepared comments. One final note, please remember to mute your device's microphone and stay on mute unless you have a question, as background noise is audible and distracting. With that said, let me turn the presentation over to Matthew Daly and Stephen Abernathy, who will provide today's commentary.
Welcome. I'm Stephen Abernathy, and this is the November 2024 First Friday meeting for the Abernathy Group family office members. This is our 24th monthly meeting, and all the meetings recordings are available on our YouTube channel and easily available on our website, just in case. And by the way, if you haven't been to our website lately, please think about considering visiting. There's a wealth of information on how to continue your journey of becoming a more intelligent and a more thoughtful investor. There are some clever estate planning ideas you might consider, as it's likely that the future will it feels like the future is going to allow U.S. citizens to pass along less of their hard-earned money to beneficiaries. And I bring this up because for many of us on the call today, the taxes on this hard-earned money we've saved are going to be a really bitter pill to swallow, especially if we're unable to pass along our estate to those we choose. Also, we recently started a new company that's focused on reducing the costs of offering employees a corporate 401k plan. And just this last week, we published a paper which you might be interested in. It discussed the fact that over 80% of all 401k plans in our database are paying 25 to 50% or more than they should be paying to administer their 401k plans. And the impact of this is that overpaying for fees and expenses lowers the probability that that corporate employees are going to be able to retire on time and with the lifestyle they enjoy currently. So in short, the grist of this is that it's a national problem with a great impact on our future. And if you have a few minutes, and certainly if you have a retirement plan, stop by and read it. As I mentioned, it became a press release with national headlines, and it just takes 5 or 6 minutes to read. It's pretty interesting. So, as we said in last month's webinar, there are well-known risks staring us right in the face. And over the last year, these risks have increased in likelihood to a level that we are starting to become a bit afraid. Over the last month, these risks have become prominent enough for us to warrant serious discussion with each of you about preparing for these risks. While each of us hope and pray these risks, we hope they're going to avoid becoming a reality. The most consequential risks are absolutely outliers, meaning they have a very low probability of taking place. However, some of these risks are so impactful that despite their low probability of becoming a reality, they must be considered and they must become part of your planning. As Warren Buffett and Ray Dalio would tell you quite easily, don't make the mistake of overlooking events which have happened many times in history just because they haven't happened during your lifetime. Many of us who pay little attention to history make this mistake. So if investors overlook this type of negative event and the event takes place, it could absolutely change your life in a very negative way. So today it's our goal to show you how to prepare your investment portfolios for the possibility of an outlier event, yet to remain invested so that if we are lucky enough to avoid a negative destiny, our investment portfolios may prosper either way. With that said, let me turn this meeting over to Matt Daly so he can discuss the topics our members have asked us to discuss with you. Matt?
Thank you, Stephen. As we discussed in our last meeting, we're going to continue on the progression here from meeting to meeting. We're going to do our best to discuss several more uncomfortable topics. However, like many important activities which involve difficult decisions, discussing uncomfortable topics before they occur can be the difference between success and failure. Intelligent investing always starts with risk analysis. We mentioned this last month as well. And as reminded you last month, the reason is because if you lose those assets you are investing, you lose the ability to invest. And as Warren Buffett has said many times, don't forget the first rule of investing. Rule number one is don't lose your money. And rule number two is don't forget rule number one. It's very simple and it's easy to understand concept. Yet the vast number of investors we have spoken with over time do not focus on risk avoidance first. And why is that? It's clearly much more fun to spend time on how our investments will deliver profits and how smart we are going to look and feel when this set of circumstances becomes reality and our investment doubles in value. This brings us to today's topic. We are going to discuss what some would say is the most difficult challenge in investing. I'm describing an event that has consequences which are so large as to be life-changing, yet with such a low probability as to be overlooked by most as being quite unlikely. The problem which exists is when you diversify, you are most likely giving up some of or most of your upside rewards for the benefit of avoiding some losses. In this case today, significant losses. Yet the calculus tells us the event is so improbable that most will avoid preparing for it at all. And when it does not happen, they look like intelligent investors. Yet the reality is that they are not intelligent investors. They are just lucky. They avoided the earthquake. So they saved the money it cost to prepare. They avoided the car accident, so there was no need to wear the seatbelt. Problem comes when random or outlier event takes place. Earthquake occurs or the car accident happens. Either could be catastrophic. Today, we're going to discuss several risks, which are clearly visible and, as said, are staring us right in the face. Some are not life-threatening, yet may be unpleasant enough to prepare for. And some are so catastrophic that no matter how small the probability of the event taking place, it's necessary to prepare. We're going to do our best to discuss whether the financial markets are pricing in these risks, and if not, then why not? So first, we will briefly discuss inflation and the challenges inflation confronts our society with. Capital markets believe inflation is firmly under control. Is this a realistic expectation, and what if they're wrong? Next, we will discuss the many outcomes surrounding our presidential election next week. Is there a risk that the outcome will take place without acrimony? Or is there a real risk that there will be some level of conflagration, which could lead to an uncomfortable change in command of the most important country on earth and most powerful? Of course, we hope and pray this does not happen. Yet, what if they're wrong? Next, we will spend a very short time on our deficit spending. I know we've talked about this a lot, but we know that it's out of control. We know it's unsustainable. However, there have been no consequences so far, and other countries are also unsustainably indebted. So why should we worry? And what if we're wrong? Lastly, as we discussed last month, in our estimation, the most serious risk and the risk that is being least priced into the market, the risk of war escalating into a global war, regional conflicts escalating into global war, which will instantly increase the risk of nuclear tensions, if you will. And finally, just as we did last month, we will do our best to discuss the options available to the US Federal Reserve as the parent in the room in charge of mopping up each of our country's missteps. With that said, let me turn it over back to Stephen Abernathy to answer our first topic of the day.
Matt, yeah, thanks for giving us such a complete background on today's topics and going over that. So, clearly there are a number of risks that we must have in our mind simultaneously. We need to be aware of each of them. And as said last month, it's standard. There are always risks and there are always activities we don't believe are risky, yet which turn out to be incredibly risky. Today, we're going to tackle the potential risks in two different categories. The first category is going to include the risks which are challenging and could create a difficult and problematic future, yet they're not life-changing. And the second category will be the risks that, including the events which could be significant enough to change our lifestyle and the way we live. Then, as always, we want to give each of you an update on I would get what we think is the most likely future, along with what we believe our U.S. Federal Reserve is planning to do if each of the risks take place. So both the minor risks and the major risks we're going to try to cover with you. That said, let's jump in and discuss the first topic, which is widely discussed. So we'll take only a small amount of time on it, largely because the historical data tell us to expect an outcome which is, I think, different from expectations. The first event is inflation. Matt, any comments on your end about the inflation situation, or you want me just to jump right in?
Well, I'll keep it brief, but I think there is a lot of questioning of, did we step in too fast with interest rates, or is inflation really under control? I think we covered that in the beginning, but I think there is a lot of uncertainty around it. So please, by all means, just jump in.
Yeah. All right. So the first thing we always look at is what are the market's expectations and what level of inflation will inflation slowly recede to the 2% level by the end of 2025. That is what the market is expecting, and that's what the market's pricing in. We don't think anyone can guess about the pathway inflation will take without understanding the administration and Washington's spending plans. And we don't know what that's going to look like until after next week. If Washington decides to continue deficit spending in the 5 to 10% of our GDP level, inflation is not going to dissipate. I want to be on the record as telling you that our country can't continue to spend 5 to 10% more than we make every year without battling an insatiable level of inflation. Inflation will grow to levels very few people consider reasonable today if we consider to spend more than our country makes, period. History tells us to expect inflation to continue to plague our country for an average of 8 years or so, with a variance of as little as 4 years and as many as 16 years once inflation exceeds 8%, which it clearly did in 2021. Most of you will remember this slide that we posted about a year ago, talking about to sort of discuss reasonable expectations of how inflation is going to impact our future. The short answer to the inflation question is that if inflation went back to the 2% level in less than 4 years, it would be the fastest return to normal or the fastest return to normal in history. And it would surprise those of us who look to history for clues about what the future likely offers us. So the short answer is we don't believe inflation has left the playing field, and it's too early to declare victory. However, we clearly admit that the economy is slowing, and it's slowing considerably, which is an event considered to be a leading indicator of inflation reduction and a leading indicator of recession. So, what do we watch for? The employment reports will give each investor a leading indicator of what the U.S. Federal Reserve's actions are likely to be. If the U.S. Federal Reserve believes we're heading into a recession, they will likely slam on the brakes and start to reduce Fed funds rates, or what you would consider the interest rate spectrum. If the U.S. Federal Reserve believes inflation is starting to accelerate, interest rate increases are in our future. And to note, if interest rates begin to increase again, it will be a complete surprise to the equity markets. Complete. Expect turbulence if interest rates increase. Matt, let's move on to election results.
Sure.
So
another topic which is unlikely to become a game changer is the presidential election.
for sure.
Although there's certainly a ton of panic around it, and I think there's partisan stuff on both sides, and stories like to be generated that if one person wins or the other, there's going to be catastrophe because of one reason or another. But I think generally speaking, we're on the same page that it's less panic inducing than maybe the media would like everybody to believe.
I completely agree. Yeah, it's a complicated topic, and one I don't think it's smart for anybody to take a side on. However, I think it's important to remind all of our viewers here that we will repeat the data that we collected and that everybody was aware of, that 75% of the U.S. citizenry did not want either candidate to become our next president. And the reason we bring this up is that despite the drastic perturbations from both sides of the voting extremes, it seems unlikely that there is going to be a civil war inside the United States, regardless of who wins. I think it is, there's a probability of this happening, but it's very small. And it appears that over the last week, the market is starting to price in a Trump victory. We're not taking a side on this. It's just we're telling you what the market seems to be expressing, because the marketplace is usually right more often than wrong. However, the tea leaves on this, they change frequently, and we just don't believe there's a risk that there will be a civil war in the United States or a serious conflagration unless this is a really close election. And either way, it's not going to change our life. History tells us that whether either party winning, the market tends to do pretty well. History also tells us it's pretty difficult to predict who's going to win, even when the polling numbers, especially when the polling numbers are as close as they are today. That said, from what we know, a Trump win will likely be a bit more inflationary in some categories, and the Harris campaign is going to be a bit more inflationary in other categories. Yet both are planning to spend approximately 6 to 10% in deficit spending. That is a significant disaster. I saw, and just will repeat a quick quote from Jim Grant, who's a very thoughtful observer of the world. When asked what the market is pricing in as a risk for the election, he said, understanding that the polling showed that over 75% of US citizens didn't want either of the current candidates to run for office, he said the real risk the market is pricing in is the risk that one of those two are going to win, which I thought was a pretty hilarious thought. Matt, let's move on to the next risk, which is our national debt. Any thoughts on that topic?
The national debt, or just wrapping up the election stuff?
Yeah, especially for the election stuff, please. Any thoughts?
Yeah, I think we've talked a lot about it, and I think we both agreed that historical data shows pretty significantly that regardless of who wins, it's not going to be catastrophically impactful. I think like you outlined, there's inflationary risks on both sides. Both sides seem to, at least in their outlined positions, significant spending plans. Of course, there's no crystal ball. We have to see what happens with whoever wins and what they end up enacting into policy, because campaign promises are very different from actuality, and there's dealing with both sides of the aisle, and also both sides of the Congress and the Senate, and what the majorities are. And there's so many factors there that we have no idea even though what's said, what is actually going to happen. And I don't think it's really panic-worthy subject at this point.
Yeah, and Matt, I think you and I haven't discussed this yet, but yesterday I talked to an analyst who went through the sort of the analysis that he was having with it, and he was describing something that was almost impossible. It was sort of a 4x2 matrix, and the 4 side was each of the outcomes that could take place in Congress. One, a blue sweep, a red sweep, either way. The 2 side was one of the 2 participants, and what made it, and that's difficult enough at best, but what made it impossible to predict is the fact that the likelihood that either of the winners as president will actually follow through on what they have said during the campaign. That's a variable that is, it is by nature undefinable. They can't guarantee whatever they've said will get through, or that they will actually do it. And history unfortunately shows us that politicians are politicians, and what they say and what they do is totally different, unfortunately for us.
That certainly sounds about right.
Yeah, unfortunately. Let's move on real quickly to this one, to national debt. The next risk that we have in front of us is, and this is one that could, and it will eventually, I want to be on the record as making sure that we're on the same page, it will eventually change the way we live. It's our national debt, and our debt load is unsustainable. So why do we say that? Why do we say it's unsustainable? And sort of the definition of unsustainable is when you don't have enough income to pay the interest payments alone on your debt. It is unsustainable, meaning when you're borrowing money to pay the interest payments, not to pay back principal, when just to pay the interest payments, your debt is unsustainable. It's not hyperbole, it's not exaggeration, and I'm not trying to be political one way or the other. It's just a mathematical fact. So something has to change, and it would be a disaster if the global markets make us change. It would be much more noble and fitting if the global superpower called the United States had the backbone and the will to stop spending on benefits that are completely voluntary. And we unfortunately maybe need to start taxing our citizens appropriately. What's the market expecting? The market seems to be expecting that the next administration will continue to create deficits and increase our debt load. You can see this as the yield on the US 10-year note continues to increase. You can also see this in the price of gold, as gold's price telling us that the markets, or I guess what you would say is the central banks, not necessarily the markets, but the central banks are starting to buy gold, and they're selling their U.S. gold, their U.S. Bonds for to raise money to buy gold. Historical data tell us that this is a slow-moving process at first, and then in a short time span of a year or two, the world gets fed up and changes take place. This is the outcome we want to avoid happening. Our belief is that if the U.S. does not handle our spending responsibly, which is going to be a painful outcome, whether we do it or whether the world does it for us, the global markets are going to punish us. What should we be watching for? We should pay attention to the rates on the long-term U.S. bonds and notes, along with the price of gold and other commodities. If the price on our U.S. bonds continues to go down, meaning the yield goes up, it's telling you that the world is starting to get fed up with our shenanigans. And if the price of gold continues to increase, it continues to show that the other central banks around the world that used to be our main buyers, they've left us, and they're now building their gold reserves for a coup. Matt, let's go on to the next topic, which is a difficult one.
Okay, yes. So definitely the most difficult, I would say. The varying possibilities of war, whether that be increased regional conflicts globally, God forbid, global world war, or potential U.S. involvement in regional conflicts or direct conflict and troops on the ground, and probably last, but not insignificant as some kind of conflict coming to our shores.
Yeah, that is real risk, and so I mean, to sort of try to describe this, what each of us should ask ourselves this question: what would happen if the current conflicts, which are bubbling up, all around the world, get to a tipping point, and it coalesces into a global conflict, which we would call a world war? And what happens if this begins? If it begins on other people's property, that's one thing. If it begins on the United States property, that is a catastrophe. So I must admit that this is a very uncomfortable topic to address, and I also admit that as a professional investor, it's an almost impossible topic to find a solution for. The reason, it could be a long-term war in which lots of lives are going to be lost, or it could be a short-term war, which likely means that there's a nuclear solution and global destruction is the outcome. So my fear is that either outcome is almost unthinkable. However, in trying to stay on topic, the market's expectations are that there will not be a world war. We hope the market's right. We pray the market's right. We also believe that the market is right. Remember, humans are mostly logical except at extremes, and game theory tells us that humans will react rationally, which means they will not begin a massive event resulting in genocide. It just doesn't make sense. Game theory doesn't support that outcome. So what history tells us is just a bit different. However, today technology allows us to be so well armed that it's likely that cooler heads will and must prevail. As most countries know, that a nuclear conflict will only end in a level of destruction which is unthinkable and which could change the planet's geography. I mean, literally change the geography of our planet. Think about that just for a second. And that's not to mention the changing of our lifestyles. So what should we be watching for? The most intelligent analysts are paying attention to activity and not to words. Don't forget, words are pretty cheap, and activity is scary. How should intelligent investors be prepared for an event categorized as an outlier event, as this is, meaning it's a low probability but a disastrous outcome? So for an event that's highly improbable yet potentially cataclysmic, it makes sense to own physical goods. So just keep this framework in the back of your mind. It also makes sense to own physical goods within the nation's control as sort of national alliances may change based on expected winners and losers of a world war. And don't forget the fact that we sequestered a ton of Russia's money during the last during the beginning of the Ukraine conflict. You know, so staying onshore and staying with assets that are energy related are thoughtful. So if the war is global and not only on U.S. or not on U.S. soil, period, owning energy assets, owning real estate assets, owning manufacturing companies with manufacturing goods within our geography, along with maybe pharmaceutical assets, those will likely remain to be intelligent strategies. For most of you on the call, you know that we've made a significant commitment to energy assets at our family office, and we're first and foremost value investors. So the value investment makes a lot of sense for family office members, especially in light of the potential for a global conflict. Next, the overall market is priced for perfection, and perfection is seldomly an achieved state. So we think that the market is overvalued. All of you know that by now. And thirdly, you know, in an overpriced market, we want to have some income generated. And we'd like to have income in the 5% plus range, because the stock market's overall, I don't know, price currently, either a significant correction is due, or more likely a decade or so of little to no appreciation in securities values is likely. So those investing for appreciation are likely to be upset, regardless of whether we go into a global conflagration or not. And for those who are value investors, it makes no sense to speculate in the stock market end of this conundrum period. If the conflagration comes on U.S. soil, there will be few places intelligent investors can hide outside of gold. There may be a digital currency established and backed by gold in an extreme situation. So you're going to have to keep your eyes open for that. But we can go down a rabbit hole with this kind of talk and this, this kind of speculation regarding nuclear war or war on the United States soil. Matt, before we move to the next topic, I know that you've done a lot more work on this than a lot of people. Do you have any more comments about ideas that I may have left out?
Yeah, so first of all, I think the risks are very high. To getting 10 degrees ahead to where, there's an attack on US soil, I think that's probably not out of the question, but relatively far-fetched and probably not an immediate concern as much as conflict, global conflict. I think something important to consider is even, hot regional conflicts, any sort of hot conflict or even cold conflict, really, but really the hot conflicts and regional stuff, especially when you have intense feelings one way or the other. These sorts of things cause the enemy of my enemy is my friend. So they cause these coalitions to be formed. I think that's something we need to watch. And then when you think about it in terms of the global economy, if for example, during World War II, one of the big issues of the United States getting involved in the war was you couldn't bring goods or troops or anything across the Atlantic Ocean because German U-boats, were just destroying everything. Passenger ships, ships packed with goods for Europe. We didn't even attempt to get troops from the United States over to Europe for a while because of you just couldn't cross it. So that is one of the most effective ways to choke out a country or make them feel pain or just cause global issues. And if you're at war with another country, you have no problem causing global issues because you're in a fight or flight mode and you're not going to be as affected as much. So I think that is, for example, in the Middle East, Suez Canal is one of the most important, one or two, maybe the most important shipping lane in the entire world. And it's very, it's a canal. But the world is dependent on it. If they were to cut that off or cut off, just see even a terrorist group in Yemen, minimal organization and, pretty decent funding, they've been bombing ships going through the Red Sea, and that's caused a huge issue. But imagine that times 10 when it becomes, a real conflict. Those sorts of things. And, if you get into the China and Taiwan thing, Japan gets cut off. That's a significant ally of ours. They'd be surrounded essentially. They have Russia, China, and if China takes Taiwan, and then it's easy to see how that coalition grows as well. That country can be totally choked off, and that's a significant ally in many ways, especially very important on the global economy. I don't want to get too deep into it, but I think we can see that regardless of the level of escalations, if we have significant regional conflicts across the globe, you're going to see different countries getting involved in various ways. And it will have an impact ultimately, I think, on the global economy and the United States economy.
Yeah, Matt, well said. And it's just when you start thinking about it, it's just for me, it's so scary. I tend not to try to figure out, especially if there's some sort of movement to cross the Pacific or the Atlantic and get on our shores, which seems for most people to be inconceivable, but certainly possible. Let's truncate that and allow everybody on the call to just have a conversation with us independently regarding this topic. And let's move on to the next topic, which is what's priced into the current market valuations, because I think a lot of people are starting to feel like the market is indestructible. So Currently, the stock market is expecting the world to be a wonderful place forever. Current pricing prices in an almost 15% growth in earnings for 4 or 5 years going forward. So think about that. Not don't forget the fact that it's never happened before. So while we're not sure the reason this expectation is so widespread, we do believe it is due to the amount of money the last 2 administrations have pushed into our economy. So combined with the returns the stock market has delivered over the last 10 years, people have become used to returns in appreciation that are in that 10 to 15% range. And remember, many people calling themselves experts have less than 25 years in the market. And that means that they really the only thing that they really know is that interest rates will continue to fall and that earnings are going to continue to grow at 10% plus each year. That's their life so far. They didn't experience any of the challenges in the pre-2000 period, or certainly the 1970s or 80s inflation scare, inflation reality. So while growing earnings at sort of at 10% plus per year, and while falling interest rates, they're not what history tells us to expect. And it's likely that those calling themselves experts haven't read enough history, and they certainly haven't experienced enough history to give them a balanced and informed opinion of what to expect. So, here's what the current pricing is telling us. We're at stock market valuations seldomly seen over the last 50 plus years. And on the other hand, the commodity market tells us that there's a decent value to be had for those interested in commodities. And remember, we commented on the fact that owning physical goods is quite sensible in a market that is ripe with conflagrations or potentially wars. So I think this can be creating an interesting opportunity for those interested in hard assets. And it's one that we're doing a lot of work on currently. Let me just stop there real quickly and check in with Marissa to see if there are any questions which have been sent to us since we started this conversation. Marissa, do we have anybody here?
Yes, we do have a question. What will the U.S. Federal Reserve do if A, we enter a recession, and B, if we get pulled into any of the wars brewing abroad?
I think, good question. Yeah, I think I know the family that sent us this. So I think the answer is pretty simple. The U.S. Federal Reserve has lots of incentive to get interest rates down. Certainly, if we have to print money to supply the manufacturing engine of the United States, if we go to war, that would be a help. Secondly, the lower we can get interest rates, the less our financing is going to hurt. So lower rates allow us to finance our deficit spending with less expensive money. So I think there's almost no question that the incentive for the Federal Reserve is to lower interest rates, lower the value of our dollar so that we can help our exports. And if inflation starts to rear its head again, I think we're going to be in real trouble. Matt, do you have any other comments on that before we change topics or start to taper down?
No, I think that's generally right. Yeah, I think interest rates, yeah, I think you pretty much covered it. It's in our best interest to to knock it down so that we can pay for the hole we're already in.
Yeah. I think no matter what way we go, I think if interest rates, if interest rates are within our control, interest rates are going down over the course of the next several years. And if we lose control and they go up, it will be because the world is punishing us. And that seems to be as likely as not over the course of the last month. What I've seen is a little bit frightening. So let us stop there. We've gone a little bit over, and thank you for tuning in, and invite each of you to, if you'd like to give us a call about your portfolio specifically. However, everybody on this call has likely done a good job already of preparing for a calamitous future, not a disastrous future, but a calamitous future. With that said, thanks, and we'll see you again next month.